Before we dive in, hit subscribe so you don't miss new episodes. If you find value, a quick like helps us reach more people. Let's get started. Today, we're taking a deep dive into something really critical: borrower due diligence, especially for those high-value loan transactions happening now, looking towards 2025.
Yeah, this is absolutely essential stuff. I mean, if you're a C-suite exec, an investor, a high net worth individual, you really need to know this.
Right, it's about protecting yourself, isn't it? Avoiding those, well, predatory practices and just navigating these complex deals without hitting major pitfalls.
Exactly. Our mission today really is to give you a practical framework, something you can actually use.
Okay, so what does that look like?
Well, it's about evaluating lenders properly, spotting those loan red flags, the warning signs, and basically getting through these big deals feeling confident.
Confident that the loan actually works for your goals, your strategy, not just some quick cash grab that causes problems later.
Precisely. And this isn't just for one type of loan either.
Good point. We're talking commercial real estate.
Securities-based loans, leveraging portfolios.
And even that whole area of alternative finance, which is, well, it's growing, isn't it?
It really is. The key thing, though, the thing we really want to hammer home today is that due diligence isn't just for the lender checking you out.
Ah, okay. You're flipping the script.
We are. Borrowers have to be just as thorough, maybe even more so.
So let's nail that down. Borrower due diligence.
Uh-huh.
What exactly are we talking about?
Think of it as your own comprehensive investigation, your evaluation of the whole deal.
The whole deal, meaning?
Meaning the lender's credentials, sure, but also every single term in that loan agreement, the legal structure behind it, everything.
Got it. Okay, so why is this so vital? What are the core objectives here when you're the borrower doing the bigging?
Well, first off, you absolutely need to verify the lender. Are they credible? Are their practices ethical? Do they operate above board?
Makes sense. You need to trust who you're dealing with, especially with significant money involved. What else?
Secondly, you've got to understand all the terms, every single one. No glossing over the fine print.
Because that's where the surprises hide.
Right, exactly.
Okay.
Which leads to the third objective, identifying hidden costs or potential legal snags, maybe risks tied up with the collateral you're putting up.
Okay, so verify the lender, understand the terms, spot hidden costs and risks. Anything else?
Yes, mitigating potential governance or compliance issues. Sometimes the way a loan is structured can create unexpected problems down the line.
And I guess tying it all together, making sure it fits.
That's the big one. Ensuring the loan actually aligns with your strategic needs. It's not just about getting the money, it's about getting the right money on the right terms for your overall plan.
So done right, due diligence turns that loan from just like a necessary funding step into a calculated financial tool.
That's it, exactly. It's proactive, not just reactive. A strategic instrument.
Okay, the importance is clear. Let's walk through the actual loan process.
Oh, yeah.
Where should borrowers be focusing their due diligence efforts at each stage?
Right, so it usually starts with a loan application. You're submitting preliminary documents. Your DD focus there should be on how your information is being handled. How seriously do they take confidentiality? Is it transparent?
Good point. You're handing over sensitive data right at the start. What's next?
Then comes more documentation. The lender's initial review. They'll ask for detailed financials, business plans, asset lists.
The deep dive from their side.
Right. And your focus. Understand why they need each piece of information. Don't just hand it over. And crucially, make sure there are NDAs or solid data sharing policies in place. Protect your info.
Okay, so understand the why and protect the what. Then they move to underwriting.
Correct. That's their risk assessment phase. Here, you should be asking questions.
Like what?
Like, what metrics are you using? What models are you applying to assess my profile? Understanding how they judge risk gives you insight.
Get a peek inside their black box, so to speak, after underwriting.
If it goes well, you get a term sheet. This is huge. It outlines the basics rate, covenants, LTV, repayment terms.
And the due diligence focus here is?
Scrutinize everything. Everything. This is your first look at the real deal structure. Go through it with a fine-tooth comb before you agree to move forward. This is a critical checkpoint.
Absolutely critical. Don't get locked in mentally before you've checked the terms. Then the final stage.
Loan agreement and closing. The final binding documents get drafted and signed.
And the DD task here?
Engage your lawyer. Seriously. Get expert legal counsel to review every word and double, triple check that everything in the final agreement matches what was agreed in the term sheet. No surprises slipped in.
Sounds like vigilance is needed at every single step. You also mentioned looking inward. Before even starting.
Yes, absolutely.
Yeah.
Before you even approach a lender, do your own internal due diligence. Know your credit history inside out. Understand your current cash flow, your existing debts and obligations.
So you know where you stand.
Exactly. It helps you anticipate the lender's questions and prepares you for their scrutiny. You're going in informed.
Right, okay. That maps the process well. Let's make this super actionable. What's on the borrower's due diligence checklist, like concrete steps?
Okay, number 1, verify lender credentials. Seriously, check them out.
What do you mean?
Licenses. Are they registered in the right jurisdiction? What's their regulatory standing? Are they even legally allowed to do this deal?
Okay, basic legitimacy checks. What else about the lender?
Look into their financial strength. Do they have a solid track record with loans like yours? Ask for independent reviews or even references if possible. A good lender won't hide this.
Makes sense. Check the lender's health and history. But the loan itself is key, right? The terms.
Oh, absolutely. Evaluating loan terms. Don't just look at the headline rate they dangle in front of you.
You mean the advertised rate?
Yeah, you need the total cost. That means the APR, which includes fees, and you need to list out all the fees. Origination, legal, servicing, prepayment penalties, any balloon payment surprises.
Because a low rate with high fees isn't actually a low rate at all.
Precisely. And think beyond cost, too. Flexibility. Can you repay early without massive penalties? Can you restructure if things change?
Good point. What about collateral and default?
Critical. Understand exactly what conditions are tied to your collateral. And know the default clause is cold. What triggers a default? What can the lender legally do if it happens?
Okay, verify a lender, dissect terms. But what about how they operate? Their, style?
Assess transparency and ethics.
Yeah.
How clear are they? Do they explain fees, risks, terms properly? Are they responsive, professional?
Or do you get the feeling they're hiding things, using confusing language?
Exactly. Is it all up front, or does it feel like there are hidden clauses lurking? Trust your gut on this, too.
And finally, the legal side. The nitty-gritty.
Understand the legal implications. Which jurisdiction's law governs the agreement? What's the exact definition of default? What enforcement rights does the lender have? Are there clauses limiting your recourse?
That's a hefty checklist, but it sounds absolutely necessary. Now let's talk warnings. What are those immediate red flags that should make a borrower pause or maybe even walk away?
Okay, big one. Aggressive pressure to sign. Especially before your lawyer has had a proper look. If they're rushing you, ask why.
Yeah, that feels off. High-pressure sales tactics don't belong here. What else?
Lack of transparency. If they won't give you a full draft agreement up front, or if they're cagey about answering direct questions, that's a problem.
Suggest they might have something to hide. What about offers that seem, well, amazing?
That's another red flag. Offers that seem too good to be true, like ridiculously low rates, almost no documentation needed usually are. They often hide massive risks, crazy fees, or could even be outright scams.
The old adage holds true, huh? It sounds too good.
It probably is. Also, watch out for unclear ownership or structure of the lender. Anonymous entities, complex offshore setups, shell companies. You need to know who you're actually borrowing from.
Right. Transparency cuts both ways. And the language in the agreement itself.
Yeah, complex or deliberately vague language, especially around covenants or default rights. If you need a law degree just to understand a clause, that's often intentional obfuscation. It's a red flag.
Okay, those are clear warnings. You mentioned a case study earlier about securities-based lending. Can you walk us through that? It sounds like a good illustration.
Sure. So we had a client, the sophisticated borrower, looking at a securities-based loan. The headline rate was incredibly attractive, very low.
Tempting, I bet.
Very. But when we dug into the actual draft agreement with their legal team, some serious issues popped up.
Like what did the deeper look reveal?
Well, first, there was basically zero transparency or limitation on the lender's right to rehypothecate the collateral.
Rehypothecate meaning?
Meaning the lender could reuse the borrower's pledged stocks or bonds for their own purposes, their own borrowing, trading, whatever. Without clear limits, that massively increases the borrower's risk exposure.
Wow. Okay. What else?
The margin call clauses were really vague. No clear triggers. So in volatile markets, the borrower would know exactly when or why they might face a margin call, leaving them very exposed. And finally, the lender had total discretion over the collateral, No independent custodian involved.
So the low rate masked some pretty significant underlying risks and a lack of borrower protection.
Precisely. And look, rehypothecation isn't automatically bad in these markets, but the lack of disclosure, the lack of defined limits and borrower protections, that was the huge red flag.
What happened?
The client walked away from that offer and chose another lender. One where the agreement clearly defined the limits on rehypothecation, had specific, transparent margin call triggers, and used an independent custodian for the assets.
So the takeaway isn't never use leverage, it's make sure you understand and control the terms.
Exactly. It's about borrower rights, transparency, and genuinely informed consent. Don't be blinded by just one number, like the interest rate.
That's a powerful example. What about peer-to-peer lending? You mentioned that briefly. Is that a viable option for these kinds of borrowers?
It can be appealing, especially the perceived speed and access to capital. But for larger, more complex deals involving sophisticated borrowers, there are specific risks to be aware of.
Such as?
Well, generally, there's less traditional regulatory oversight compared to banks. Underwriting standards can vary wildly between platforms. Some might be less rigorous. There's usually no deposit insurance like with the bank. And you also have to consider the solvency and governance of the P2P platform itself.
So the due diligence needs to cover the platform, not just the loan terms.
Absolutely. You need to investigate the platform's financial health, who's backing it, their security protocols for your data. It adds another layer to your checks.
Good to know. Okay, let's pull together some best practices then. Concrete advice for borrowers engaging in these high-value transactions.
Number 1, start early. Don't wait until you're desperate for funds. Give yourself time to shop around and assess properly.
Avoid making rushed decisions under pressure. What else?
Always compare term sheets. Get offers from at least 2, preferably 3, lenders. Benchmark the rates, fees, covenants, collateral requirements.
Creates competition and gives you leverage.
Exactly. And, as we said before, engage legal counsel. Never, ever sign a major loan agreement without a thorough review by an experienced lawyer specializing in finance.
Non-negotiable.
Absolutely. Also, negotiate from strength. Use your strong financial profile or high-quality assets to push for better terms. Don't just accept the first offer.
It's a negotiation, not a dictation.
Right. And maintain meticulous records. Keep copies of all offers. Track changes during negotiations. Note down key points from conversations. This documentation is your backup if issues arise.
Good governance for yourself.
Oh.
And finally,
Keep asking questions. Clarify every single clause you don't fully understand. Don't accept vague answers. Persist until you have complete clarity.
clarity is power, as you said. Stepping back a bit, this all seems to build towards trust, doesn't it, in the whole financial system?
It really does. Trust is a two-way street, right? It requires transparency, ethical behavior, open communication from both sides, lender and borrower.
And the payoff for borrowers who do this homework.
It's huge. You avoid potentially disastrous pitfalls, you secure financing partners for the long term, not just one-off deals, and you protect your reputation and your assets.
So the core message here seems to be that borrower power really comes from being prepared, doing the due diligence, and negotiating effectively.
That's the bottom line. Don't just accept funding, scrutinize it. Apply the same rigor to evaluating the lender and the loan as they apply to evaluating you.
It levels the playing field.
It elevates you to an equal partner in the transaction, not just a supplicant. You're making an informed, strategic decision.
Thanks for listening. If today helped or made you think, hit like it tells the platform this content matters. And tap subscribe if you haven't already. See you next time.
And here's something to think about. For your next high-value loan, what specific borrower protections would you absolutely insist on having in that agreement? And why are those particular safeguards so critical for your financial future and strategic goals?